Okay, good morning, everyone. Thanks for joining us today for our webinar, The Intersection of PPP and ERC, How to Get the Most from These Two Programs. Welcome back to those of you that have joined us before to talk about PPP. Today, we're going to talk a little bit about an additional program that's out there that I think a lot of companies will have access to, and it really intermixes in with the PPP offerings that we've had, and it's going to really focus on the same payroll dollars. So I think this is a great opportunity for companies that have seen a downturn in their operations to get access to some additional funding. And this is really more of a little bit of a long-term funding, not necessarily that quick gratification that you got through the PPP program. A few housekeeping notes for this morning. I've got three people on the line with me. Cole Marr, who's a director in our R&D practice and is heading up our employee retention plan credit work. And then I've also got Ariane Woods, who works with Cole, who's an ERC specialist for us. And then Dean Plank, who's on my PPP forgiveness team. He's joining us as well. And Ariane and Dean will be in the background trying to answer questions for you. So as you will see, we have the Q&A function enabled. So any questions that you have, please put those into the Q&A, and we will try to answer as many of those during our presentation as we can. If we can't get to them, we'll do some follow-up with you after the fact. But between myself and Cole and Ariane and Dean, we'll try to get to as many of those as we can. The chat function is disabled for this, so really that's a one-way direction between us and you. And I've also got Dee Bowers on the line today as well, our marketing person for SSF Consulting. So she's there to help with any troubleshooting that you may have. She'll be providing some information to you throughout the presentation in terms of links to our website and additional information. So we will be recording this. Give us a little bit of time to get it cleaned up after the fact today, and we'll push that out to you later today. So anyone that has signed up will get a replay of this later on today. Okay, here's our agenda. I'm going to cover some recent PPP updates. Cole's going to go over the ERC overview and eligibility and benefits. We'll talk a little bit about how to leverage both of these programs. We'll give you our view of the areas of concern as it stands today, give you some things to keep in mind. And as I mentioned, the Q&A is open. Typically during our webinars, we get a lot of questions during the webinar, which is fantastic. We look forward to that. And we'll try to answer as many of those as you can. And we'll also leave some time at the end, hopefully, depending on how many questions we get during this to do Q&A at the end. Okay, so changes from December 28th. It's hard to believe that the last 4 months have gone by. We haven't done a webinar on PPP in a while, but there's been a lot happening, and I want to just give you a quick update of some of the highlights. So as you saw in March, new forgiveness forms were issued. I think we're now at a point where those have stabilized. So if you're under $150,000, you're going to be in good shape. You basically just need to file that form. The rest of the forms have been updated as well. Good news for Schedule C filers. They increased the amount that you can potentially get because they allowed you to use Schedule 7 line 7 versus line 31. For those in the hospitality industry, which are those with an NAICS number that begins with 72, on PPP round 2, good news for you there is that you're allowed 3.5 times your average monthly salary in terms of a loan. So if you haven't applied, please hurry up and do so. It sounds like they're predicting running out of money sometime around the end of April, but definitely before the May 31st cutoff, unless they add more to it. And that's still up in the air right now. Some also good news, they decided that the expenses would be fully deductible for federal purposes. Unfortunately, for those of us in California, there's still a question mark there. The last round of information I saw there was potentially up to $150,000 would be allowed to be deductible, but nothing above that. So we're still hoping that we'll see some change there, but I'm not confident at this point that we will. And this becomes important, this last item here. So the covered period, if you recall for PPP1, for most of what we talked about previously, the covered period was 8 weeks or 24 weeks. Well, they've now amended that, which makes a lot of sense, and said you can go anywhere from 8 weeks to 24 weeks. And that becomes important as we start to cover some things later on in this presentation, some of which are going to start here on this slide, which are some additional changes in terms of expenses that will qualify. So no change to the 60-40 concept. At least 60% needs to be payroll. You could use 100% on payroll if you wanted, but at least 60% needs to be used there. But they expanded what you can do with that other 40%. And they added these 4 categories that I've listed here. First up is what they call operating expenses. And this, what they really define there is technology. So if you're having a problem trying to manage your business remotely and you need new software to help you with accounting, with POS, whatever it is, basically, what I think about typically is, is my general ledger something I can access remotely? Is there other software in the business, maybe at bill.com or something like that? Those are all opportunities to use these dollars to pay for the implementation of those services. We would love to talk to you about that. If you've got a desire to learn more about that, please reach out to me directly, and my information will be at the end of these slides. And then some other categories that they added, unfortunately, the property damage really deals with places that have been looted, supplier costs and worker protection expenditures. Those are pretty broad categories. So I think for most folks, being able to utilize that 40% is going to be pretty easy at this point. And originally, we kind of shied away from that because there's a lot more documentation requirements around that. You've got to provide the invoices. It was just going to be harder to do. But as we pivot a little bit and talk about the employee retention credit, we may want to adjust that payroll only strategy that's been out there. And I say may because it really depends on the facts and circumstances of each individual company. And there's no silver bullet related to this. It's really doing an analysis in Excel and understanding, the components of what your facts and circumstances are. From a big picture, what I see is if you are a company that has a lot of higher wage earners, being able to maximize the PPP and ERC together is going to be a little bit easier. If you're, someone that's got a bunch of lower wage earners, it becomes a little bit more complicated, okay? But you can still do it. It takes a little more analysis along the way. I see a question there about if you have Schedule C and employees. Yes, you can now file all of that on one form. So you would put yourself down in terms of line 7, that would cover you. So your maximum amount there would be $20,833 for a loan. And then you would also import all your payroll information so that your employees could be taken care of there as well. And if you need help, you can reach out to us on that. Big picture though, with the interaction between PPP and ERC, the PPP is still a better deal for you because you're going to get full forgiveness, and that's hopefully going to be a non-taxable item for you. But that being said, there are some opportunities to really take advantage of both of these programs. And the ERC, which you'll hear from Cole in a little bit, is not a tax-free deal. So it's a cash flow play of getting money now, and you probably owe some taxes on it later. But it's still a really good deal if you can get your hands on it and you qualify for it. And just one very important piece here, you cannot double dip, which is where the complexity comes in on all this. And Cole's going to run through some of the ways that you look at this in just a second. But if you use the dollars for PPP, you can't use them for ERC. So Cole, why don't you talk to us a little bit about the employee retention credit now?
Sure thing. Thanks, Frank. So the employee retention credit was originally meant to incentivize businesses to retain employees through an impacted pandemic period. The way it's turning out is, as Frank mentioned, it's a more longer-term cash flow play. The process has become relatively complicated, especially in terms of maximizing it, right? So if we're trying to maximize the credit, we can't double dip between the employee retention credit and PPP funds. Not everyone is sure how they're going to file for forgiveness for PPP2. That creates a timing problem. So all that and several other things that we're going to cover here in the next few minutes lead up to the fact that there's no major hurry to claim this credit. But because it is such a lucrative and potentially valuable opportunity, we need to get it on people's radar screens. So the really powerful part of this is that it's a refundable payroll tax credit. So it's claimed through the quarterly payroll tax filing via a 940 or an amended 941X if you're going back to a prior period that you might have missed. And it's really available to companies of all sizes. Again, refundable for those of you who don't have experience with refundable tax credits, of which there are not that many out there. You'll be able to offset not only the payroll tax that was due during the quarter, but any additional amounts over and above that would be refunded to you. So the headline number to think about is really 2 time periods. The 2020 maximum credit is $5,000 per eligible employee. And the 2021 headline number, assuming you qualify per quarter, would be $7,000 per employee per quarter. So a maximum potential of $28,000 across all quarters of 2021. So taking a little bit of a step back, we thought it was important to address, and explain a little bit of the timeline here, just in terms of the fact that we've been encountering a lot of companies that have said, well, we looked at this originally and we didn't qualify, what is new? And the answer, fortunately or unfortunately, is there's a lot new, and it continues to come at us. So this tax credit was originally established in the CARES Act in March of 2020, at which point, if you got a PPP, you were not eligible for the employee retention credit. Well, then at the very tail end of December, when the Consolidated Appropriations Act was signed, it opened up the floodgates a bit, if you will. So companies that had a PPP were now allowed to claim the employee retention credit. And at that point, it was extended and enhanced for Q1 and Q2 of 2021. And then moving forward, a couple of months, the beginning of March, we were issued some guidance that clarified a lot of the questions existing in 2021. Didn't get us all the way over the line on some of the questions, but provided a good basis to start to move forward on 2020 claims for companies. And then the employee retention tax credit was further expanded and extended to Q3 and Q4 of 2021, relatively close to the same version that was extended into Q1 and Q2. So there's actually one further update as of a couple of business days ago. There's been further guidance issued relative to now Q1 and Q2 of 2021. So as you can see, that these things are still evolving and still changing rather rapidly. So this slide is a summary overview. So I apologize for it's a little bit complex, and there's a lot of information to cram into one slide. But what I want to focus everybody's attention on here is the 2 columns, right? We have a column for 2020, sort of in the middle. We have a column for 2021 on the right. And that's because, as I just walked through with you, the credit, the employee retention credit, is in existence for 2020 and 2021. However, many of the eligibility guidelines, the qualification thresholds, I guess obviously the time period, and the credit amounts change between 2020 and 2021. So to focus on the most important part is, do you qualify? Because before it matters how much the credit would be to your company, you need to understand, do I most likely qualify or not? There's really 2 main ways a company can qualify. And the big red or I want to highlight up there on the top right-hand portion is this is an or, not an and on this eligibility test. So the first one is if your business was fully or partially suspended by a government order, then you will be qualified for the portions of time that your business was impacted. So this qualification is just that, it's very qualitative. And there's a lot of complexity involved in, were you clearly impacted by the government order? How were you impacted, in documenting those things? So the thing that we've been focusing on for many clients is the second way to qualify, which is a substantial decline in gross receipts. The important thing to remember with the substantial decline is whenever we look at the quarter-to-quarter gross receipts, we're comparing it to the same quarter in 2019. So to qualify in 2020, you needed to unfortunately experience a 50% decline in gross receipts compared to the same quarter in 2019. And then moving into quarters in 2021, that threshold has been loosened up a bit. You need to experience a 20% decline in your 2021 quarter compared to the same quarter in 2019. And then going down to the bottom, the maximum credit. I just want to note that you'll see this as stated as 10,000, potentially a maximum of $10,000 in qualified wages per employee. And then the credit rate is 50% in 2020 and 70% in 2021, which gets us to a maximum annual opportunity in 2020 of 5,000 per employee, and then a maximum quarterly opportunity through all 4 quarters of 2021 potentially of $7,000 per quarter.
So Cole, that concept of $10,000 in qualified wages is really where the intersection of PPP and ERC comes together, because remember, we're probably going to be in a covered period for a lot of companies that received a PPP1 or PPP2 loan during parts of this. So the tricky thing that comes into play is, how do you bifurcate those dollars between PPP and ERC? And by the way, we've seen it get as sophisticated as, you're allocating payroll during one period, but perhaps not payroll taxes or healthcare benefits that are paid by the employer. So this becomes a pretty large Excel spreadsheet, which unfortunately, it's not as simple as just plug and play. There's a lot of maneuvering that you need to do and understanding the program rules on both sides so that you can figure out how to maximize what you're doing between the two programs. Yeah, so there's some work to be done there.
Yeah, and I just want to add a real key to that, right, is knowing which quarters in 2021 you're going to be eligible for the employee retention credit. So unfortunately, it's very hard to tell the future, especially nowadays, but that's one of the factors at play here to make sure that you're maximizing this credit. A lot of people are, I'm sure, hoping that they're not going to qualify, quite frankly, for Q3 of 2021, but it's hard to know, sitting here today. So it just adds a layer of complexity.
Yeah, and the other thing you mentioned that I think is really important is it is an or concept here. So what we've been trying to focus on, first and foremost, are those companies that have seen, a dramatic reduction in revenue or gross receipts, as they call it, that 50% in 2020 and the 20% in 2021 as we've gone through the first quarter. Those are going to be the easier ones to deal with. I expect that we're going to get a bunch more guidance, similar to what we did on the PPP side early on, where this program gets announced and rolled out, but there's no practical guidance on how to apply some of this, because I've read through the rules, and this concept of fully or partially suspended, you could push the envelope there a little bit if you wanted. I'm not sure that you necessarily want to. Cole, there's a nominal test in there, right? It's like 10%. If a piece of your operations are 10% or more, that's considered to be more than nominal, which may help in some of that.
Yeah, and that has to do with the fact that if your business was partially suspended, or let's say you have 3 locations and one of them was in an area that we determined to be partially, at least partially impacted, the IRS has made very clear that all of your locations in that scenario would qualify for the employee retention credit. So that there's some things that are very clear in this. Unfortunately, one of the very gray ones is, what does fully or partially suspended mean? And I just wanted to add one other complexity on the eligibility, not that we don't have enough already, but if you're sitting there thinking, gosh, I wasn't partially suspended, I didn't have, that big a gross receipts decline, there is technically a third way to qualify yourself for this credit, and that is a supplier disruption. So I won't take much time covering that right now, but I just wanted to add that out there, that if you're not meeting either of these qualifications, if you had substantial difficulty procuring supplies necessary to your business, you could potentially make a claim based on that eligibility requirement.
Great. Let's keep going. Oops, sorry. There we go.
Okay, so the benefits of this, the headline benefit is money, right? You're going to get some money at some point in time, but how can you utilize that, right? We've talked about you can get a refund. If you've determined that you've qualified and you've calculated the amount prospectively as you go, you could retain the 6.2% of FICA that you pay each pay period in payroll tax, and then you essentially just square up at the end of the quarter and request the remainder as a refund. Also wanted to point out that when we get to Q3 and Q4, that potential to keep the 6.2% in flip-flops over to the Medicare portion, which is 1.45%, therefore decreasing the cash flow impact if you were going that route and knowing that you qualified in Q3 or Q4. But, again, the big benefit is likely a large cash benefit at some point in the future. We think that if you make a claim for 2020, getting into an amended claim for Q1 at this point, even Q2, we're seeing that the refunds are taking some time, so you could expect the cash impact to happen hopefully in Q4 of 2021 or likely Q1 of 2022. So it's taking a bit of time in that respect. And then just again highlighting what we just went over, that the gross receipts qualification is the real bright line test in this, right? If we can show that you met that significant decline in gross receipts, it's a very strong footing to be on and to expect these refunds, assuming that it's calculated and documented properly.
So some considerations if you're thinking that you might be able to leverage both of these programs. On the PPP and the ERC, we mentioned this before, and we'll say it again, and we'll probably say it again before we're done here today. You can't double dip. And so this is where it gets a little bit complicated, because you have one pool of payroll dollars to deal with here, right? And you've got to allocate portions to PPP so you can maximize your forgiveness there. And then you also want to look at how you can potentially maximize what's happening on the ERC side as well. So, and then when you go to apply for forgiveness for PPP, you're going to need to be able to explain that to whoever's looking at your PPP forgiveness application. So, a word of caution there: don't shortcut yourself on what it's going to take to get that done. And I would imagine that when you go to apply for PPP forgiveness, assuming you're going for ERC, you're going to need to show a reconciliation. Basically, here's my total payroll. Here's the dollars we've applied towards ERC. Here's the dollars we've applied towards the PPP, so that everybody understands what you've done. And a little bit of upfront work there will keep you out of trouble down the road, because once all of this gets in and reconciled, you could be in a position of a problem, down the road. And one thing I want to mention, so when we first went down this road, we talked about this payroll only strategy. So for example, say you had a $500,000 PPP loan, and when you filed for forgiveness, you put down $700,000 worth of payroll on there because you just wanted to be sure that you had more than enough payroll. Well, that additional $200,000 that you put on that application could come back into play for the ERC. So it's only the amount that you actually needed for forgiveness. And there's definitely some Q&As out there in the tax literature that talk about that particular situation. What you're not going to get if you've already filed is the ability to go back and pull in that 40% potentially of the other costs. So payroll is a minimum of 60. That other 40%, you're not going to get a chance to go back and amend and fix that. But you could fix that prospectively if you have a PPP round 2 loan. And the other thing about the ERC that is great, so say you didn't qualify for PPP 2 because you had a 22% reduction in revenue or a 20% reduction in revenue. Well, that's going to still allow you to take advantage of the ERC. And based on what I'm seeing so far, the dollars associated with this employee retention credit can be pretty substantial. So this is not something to take lightly. When you think about it, I see the bigger opportunity is really in 2021. If you could take advantage of it for all 4 quarters, that's $28,000 per employee or $7,000 a quarter per employee, assuming you can get up to that $10,000 limit of payroll above and beyond what you may be pushing through in PPP forgiveness. So it's going to be something that I think you need to take a look at and understand whether or not you qualify. And so the other thing, did you have something, Cole?
Sorry, yeah, I was just going to ask Frankie. We've been talking about the forgiveness strategy, oriented to PPP2, but I'm thinking maybe some people out there if they haven't filed for forgiveness for their first round for whatever reason, are these still, applicable to PPP1, or is the payroll only strategy a thing of the past, even with PPP1 forgiveness? And when are they required to file for forgiveness for PPP1? I mean, is there any deadline for sure coming up or anything like that?
Yeah, so the absolute deadline in terms of filing for forgiveness on PPP1 is the due date of your loan. So that's going to be out, April, May, June, basically down the road. So you've got plenty of time, and that would be 2 years out from when you got the loan. So we've still got over a year for that. The reality is payments start on these loans 10 months from the end of your covered period. So for example, say you got your loan in April and you used a 6-month, 24-week covered period. So that would drop you into October. You'd have 10 months from October, right? So that takes you up to about August in terms of when you'd have to start making an actual payment on PPP1. So say you get into a position where you had to start making payments on PPP1 because you're still trying to figure all of this out, you'll get that money refunded back to you when you go ahead and file for forgiveness. So you're not going to lose out on it, but the reality is you're not going to have to make a payment until about that August timeframe, which is good. So it gives you some time to digest this, to figure out, what makes sense. And like I said, that payroll only strategy may change a little bit now. And if you qualify for the ERC, then you may want to try and bring in as much other cost to eat up that 40%. So you have less money being taken up for payroll for PPP, so you can push more money to the ERC. But really, you have to get down to that quarterly analysis that you're talking about, and you almost have to analyze payroll on a periodic basis. So whatever, if you're weekly, monthly, every other week, or whatever your payroll frequency is, you're going to have to get in and analyze that. Now, the good news is, as we saw with PPP, many of the third-party providers are going to have what they call their ERC reporting. So that's the good news. The bad news is I don't believe they're going to maximize the benefit for you between ERC and PPP. They're just going to give you information that shows you payroll that may qualify for both, but it's going to take some figuring out of how you bifurcate that payroll and what amounts. And it really needs to get down to a very granular level. And in some instances, you may need to get down to that periodic basis, like I mentioned. So I had a call with some of the payroll companies a few weeks back, and they said that they didn't think they would be doing anything to maximize the benefit between both programs. They're just going to report on it. So stay tuned. That is something that may change, but I at least wanted to throw that out there. And then Cole, you're going to cover some of those limitations, right?
Yes, there's a couple of limitations we wanted to make sure everybody was aware of, and these largely are relative to, do you qualify, and then what are the expenses that qualify. The two big ones are the aggregation of gross receipts and employees, and this is when we're talking about the thresholds for that 2019 comparison period, and then quarterly going forward. So if there's common ownership of multiple businesses, meaning 50% or more common ownership from one individual, those gross receipts and the full-time employee counts need to be aggregated together. Even if those businesses are wholly independent, don't operate together, don't communicate in really any other way other than, common ownership, when they really have to be bunched together in terms of figuring out some of the eligibility requirements. And then the next one has come into play a lot, obviously, with closely held businesses, is a 50% owner and direct relatives of a 50% owner cannot be included for the employee retention credit. Their wages would not be an eligible wage. I believe, Frank, that there's not this exclusion relative to the PPP forgiveness money. So that's an example of, you could allocate all of those resources or all of those wages towards potentially PPP forgiveness, making some room on some other people's wages for the employee retention credit. Just another one of those factors at play.
Yeah, I've seen a lot of forgiveness applications come through on these family-run businesses where the owners have said, hey, just put my employees down on the form, don't put me down on there, right? Even though they were eligible to be down there. And there are, stricter limitations on owners above 5% on the PPP forgiveness. You're limited to a maximum of $20,833 for the most part over a 24-week covered period, and you'd have to haircut that back if you used a lesser period. So, but that is a way to get through more of those dollars. I will tell you, this concept of aggregation is what drove a lot of people a little bit crazy on the PPP side, and the rules here are pretty similar. If you are, although the percentages I think may be a little bit different, if you've got businesses that you own, like if you're an entrepreneur and you've got a construction company and a bar and an auto body shop that you all own, those businesses have absolutely nothing to do with each other. But if you're a greater than 50% owner in all three, you got to aggregate all of them together. And that makes people a little bit unsure about how to do this and adds a layer of complexity to it. But definitely, this thing caught me a little bit off guard, the related party aspect of the ERC. So that stuff really has to stay out of there. But you do have opportunities on the PPP side to take advantage of that and push those dollars over there. So that's an example of one of the strategies that you may have to employ that we could help you with.
So we just wanted to cover some areas of concern. I mean, we've talked about several of these in some way up to now, but the big elephant in the room is companies that will qualify based on their operations being fully or partially suspended due to government orders. What does that mean? How do we interpret it? We've gotten some guidance, but we suspect there'll be more coming, and it's basically arriving all the time. We've got a little bit over the last few business days, we got a little bit more guidance. So, the good news about this fully or partially suspended qualification is a lot of people are not relying on that, because if you had your business fully suspended, in many cases, your revenue was also impacted to the extent that you can qualify based on the gross receipts reduction. I guess also important to note is, lending towards the fact that there's no huge hurry on jumping to conclusions on whether or not you qualify, is that you do have up to 5 years to amend and claim any missed amounts. So, even if you get outside of 2021 and figure out that you qualified, or now maybe you feel comfortable with your PPP status and you've figured out how you could file for that forgiveness and then done some rough work around the employee retention, you haven't missed anything, you can still go back and make those claims for several years into the future. So the reason there's so many caveats, or one of the reasons there's so many caveats around a suspension due to government orders and some of the details of this, is that the original tax law is very light on tax law actually, and heavy on FAQs. We got a series of 100 FAQs last year, and then we got more guidance a few days ago. So it keeps trickling out and keeps evolving as we go. And then we also wanted to mention, the refunds are taking a while to receive. So based on the evidence that we have right now and some clients that took advantage of this program over the summer, they're just starting to receive those refunds. So it's really looking like, whether you go back and amend, or you claim it on a timely filed return, it's taking 6 to 9 months to work its way through the IRS and have those refunds issued. We're hoping that as we move through the year, maybe that could speed up a little bit as the IRS gets some processes in place, but I think there's no guarantee of that, and everybody should just game plan that it's going to be a 6 to 9 month wait.
Yeah, and in theory, Cole, what may happen, and we've seen this kind of on the PPP side as well, is, I kind of think about where we are in the year, right? We're coming out of the audit and review season and kind of the tax return season, and now people are starting to pivot and focus on what else is out there, right? So I think we're going to see an uptick in filings related to the ERC that may actually slow that process down a little bit, even more so than what we're already seeing. So for example, in the PPP world, remember the SBA had 90 days to review those loans over $2 million. Well, I don't know of any that I've seen so far that have been through that full audit process, even though they were filed, well over 90 days ago. So the timing may get pushed out a little bit. But I think the biggest takeaway here is there's no rush to do this right now. And so, like I said at the very beginning, this is not a quick cash flow play. This is more of a longer term cash flow play, but the dollars can really be significant. So it's worth taking a look at. And with that 5-year horizon to go ahead and apply, my thinking is, from what I saw with the PPP program, it was better to wait. And I think it's better to wait here too, especially if you've got some uncertainty and you've got some characteristics of your company profile in terms of what's happened that, you may be teetering on the edge of whether or not you can apply for this or not. It's best to wait, let some more guidance come out, let the Q&As come out. It's starting to happen. We saw some stuff come out, just a couple of days ago, and that's going to continue to trickle out. The more companies that file, the more opportunities they get to examine that on the back end and then revise guidance so that they can help the rest of the companies that are out there.
And let me point out real quick too, because I've had this question from companies, is that theoretically there's no money to run out, right? The ERC is not a program where there was an allocated amount of money, for which people are lining up, and once it runs out, there'll be no more claims. It's a refundable payroll tax credit, and the program will last through its statute date, and anybody who can rightly determine that they qualify and make their claim will be able to receive their money.
Okay, let's talk about a couple of things to keep in mind now. So, and we've mentioned some of these throughout the presentation today, but I just want to reiterate it again so that we can drive this point home. So, Cole asked this a couple of slides ago in terms of when do you have to make loan payments. So, we're still a ways away from that, and really, there's a lot of unknowns around getting your 2020 taxes filed at this point. If you've got a PPP loan, and we're trying to figure out whether or not you're going to, get full forgiveness and be able to deduct all of those expenses. For federal purposes, your returns ought to be in pretty good shape by now, assuming you got all your information into your tax provider. But for California, it's just an open book right now. So we're not quite sure what to do there. So our advice in that situation is to just sit on those returns as they stand as of today.
Yeah, so then we have 2 tax implications here, things that we haven't touched on, but important to keep in mind, is that when you claim the employee retention tax credit, you're basically wiping out your payroll tax that you paid in that quarter or the periods in 2020. So you lose that payroll deduction you might have received for tax purposes. So you'll have a bit of a tax impact at that point as far as your expenses of your business go. And then when you receive a refund, you get the check in the mail or however you receive the refund, it will likely be a taxable event. As of now, you should assume that when you receive that money, it'll be a taxable event in the time period that you receive it. So we are not anticipating it to be kind of tax-free dollars as the PPP ended up being in 2020. And then a couple of quick things that we've touched on up to now is that refunds are taking a while, and we've all got our fingers crossed that they'll start to speed up, but they may actually slow down. So there's no way to tell the future, but we should expect 6 to 9 months. And then we have a 5-year window to amend. And then also, I guess I'll point out that that also gives the IRS 5 years instead of the typical 3 years to examine claims and go back and ask any questions.
And then, as you might expect, as we're dealing with another government program, which the credit falls under another government program, the definitions are just a little bit different in terms of for sure the concept of full-time employee. So as you know, under the PPP program, full-time employee is 40 hours a week. When you pivot into ERC, the concept of a full-time employee is 30 hours a week or 130 per month. So don't ask me why. That's just the way the program requirements are laid out. And I do believe there's also a slight difference on what counts as wages, but we need to dig into that a little deeper as we look at both programs. There's some real tricky nuances in there related to healthcare benefits and 401k payments as well that are going to need a little bit of unraveling as we move through there. And then really it's time to take a hard look at that 60-40 split on your payroll or on your eligible expenses for PPP to see if there's a way to maximize both so that you can take advantage of more of these government dollars that are available out there, which really leads you to that allocation of wages on a person-by-person basis, which once again is back to that giant Excel sheet that I have in my mind that it's going to take to get through this. And then how you actually sequence out those expenses over the covered period becomes important, because you may want to, say you got your loan on March 1st, well, you may not want to put payroll dollars to that until April 1st, right? And as long as you still abide by your covered period, I think that's going to be okay. But every company is going to be different on this. You're not going to be able to really, apply this easily across the board. There's no kind of one size fits all approach here. It really takes that level of analysis for each and every company. And some companies will be easier and some will be a little more tricky, but that's where we come into play and can help with that kind of analysis. Next steps, Cole, you want to cover those first couple of ones?
Yeah, so first things first, right, is to determine whether you're an eligible employer and what periods you might have qualified wages in. So that's going to help you help you understand, where am I in the timeline of how to claim this? Should I be, going after periods certain right now? Am I in a situation where there still needs to be more clarity, et cetera? And then just documenting how you qualified. So making sure, you've figured out what your gross receipts are by quarter. You have that information. You have 2019 employee counts, things like that. Just as drawing that line in the sand, thinking about moving forward to the time in which you're going to actually quantify the employee retention credit and figure out how to make a claim.
And then if you haven't filed for forgiveness, it's time to take a look and see if you would qualify, like Cole was saying. If you're eligible under the ERC, then it might make sense to put the brakes on filing for forgiveness and take a look at this and see if you can maximize both programs, because it's really more dollars for you and your company, which is very helpful to keep operations moving. And then, rethink that strategy to perhaps maximize the 40% category. We gave you a few examples of how you could do that today. So I do believe there's going to be opportunities to take further advantage of both of those. We've set up a landing page on our SSF website. So if you were to go to the main SSF website, www.ssfllp.com, you'll see a big green banner similar to what a lot of other websites have at the top. If you click on that, it'll take you to a page that has both our PPP and our ERC pages linked to it. And if you click on that ERC page, and I think Dee is going to put that into the chat so that you will have it there. There's a section there for you to put in some information if you'd like to try to connect with us on this. If you put that information in, that will allow us to have a much better conversation with you and engage with you relative to this. So a little bit of upfront work will make those conversations be a lot more meaningful. So I think that's it for the prepared comments. Oops, sorry. Now we want to, deal with any questions. I know there's a few that are out there in the chat. We've answered, looks like 44 questions already as part of what we're doing, and it looks like Lee has a hand raised. So
I've got 2 questions that I'm not sure of. I'm going to lean on the fact that I'm an engineer. If a company gets the credit for 2020, when is that reflected on the tax return? Because I don't actually know the answer to that question. We have 2 outstanding for that.
So if they receive the credit for 2020, then they're essentially going to have an adjustment, right, to the payroll tax expense that should be able to be reflected in a current tax return with just a change made on a live basis, and then the refund will be accounted for in the period you receive it. So that will just be an income tax item in the period that you receive the refund. So I think the headline there is that there won't be a need to go back and amend. For instance, if you've already filed your 2020 tax return, there shouldn't be a need to go back and amend your 2020 tax return. If you make a claim in 2022 for 2020, you lost that expense for the payroll tax, it'll be able to be worked out. You shouldn't need to amend that 2020 tax return.
Okay, we'll give it a sec and see if any more questions come in. In the meantime, I want to thank you all for attending today. Please visit that landing page for more information and fill out that data request for follow-up. As things continue to change, we will update our website and perhaps schedule another webinar. Please connect with Cole and I on LinkedIn. You can find both of us there. If you want, that's a great way to get information from us, because both of us are relatively active there, and we'll push out guidance as we see it through LinkedIn. I see there's a few more questions coming in. Explain family attribution rules for the ERC. Cole, that's the 50% or more owners, right? They're direct family. So siblings, brothers and sisters, aunts and uncles, all of that would not apply for ERC. You can still claim that on the PPP side, assuming they've got payroll dollars there, right? But from just the easiest way to think about it from an ERC perspective is your direct family, you're not going to get credit for it in the ERC world, correct?
If you're a 50% owner. So yeah. I mean, if you're, if we got an ownership group, 25% apiece, one business, they all employ their family members, but nobody owns more than 25%. I think we're relatively safe there. But definitely if it's, a wholly owned business and you have multiple family members, and the definition of a family member for exclusion in the employee retention credit is actually pretty broad. So it includes in-laws, it includes aunts, uncles, nieces, nephews. I mean, it extends out there a ways. So I think it's important to be on the right side of that interpretation.
Yeah, and definitely there's some complexity there, and the questions keep coming in. If we're a cash business, can we push revenues into a subsequent quarter to qualify based on the income reduction for both PPP2 and ERC? That becomes a little more of an ethical decision at that point in time.
Frank, if you don't mind, I'll make a quick comment based on my thought relative to the employee retention credit, and that's I've had conversations with several businesses at this point that said, how do I allocate by quarter? I've never thought of it that way, right? I've always just thought of it as on a tax basis, right? We're talking about calendar year 2020. That's what I'm concerned with, and I think the answer to that has been, well, let's discuss the specifics of your business. How the revenue is coming in, what your contracts looks like, et cetera, and develop the approach to allocate the income by quarter that would make sense if neither of these programs existed, right? Let's get comfortable with how you would have to allocate income by quarter if you just had to do it for any reason, regardless of what it was for. And then we'll go with the results of that, right? Because like I said, just a lot of people have never thought about allocating it by quarter, have never needed to allocate it by quarter. But we might need to develop a methodology and get comfortable with how we're doing it, and as long as everybody's comfortable with the methodology that we come up with, and it makes sense on a tax basis, I think for the ERC, we can be confident in those results.
Yeah, and there's a question from Karen. I think you have that wrong. So whatever you get from the credit will be considered taxable income, correct, Cole?
Sorry. So what is so basically it's defined on the form 941 and 941X as non-refundable. So I think the question is that quote non-refundable amount, which is offsetting the taxes paid. I think in a technical sense, yes. So that would not be subject to the income tax in the lump sum when you receive the refund. It wouldn't be included in that amount. That would impact a prior period. So I think I'm probably butchering that question a bit because it's a pretty detailed question. But yeah, but rest assured, in almost every scenario that we've helped someone with this credit, the total credit dollars have so far exceeded the actual payroll tax expense, that 6.2% paid during the quarter. I mean, it just absolutely dwarfs it. So it's actually it'll get worked out, but it's a somewhat minor concern in the overall opportunity of this entire and scale of this entire opportunity for the employee retention credit.
Yeah, and there was a question there about SSF Consulting and SSF. So Sensiba Sanfilippo is a full service CPA firm, audit tax. I run the consulting arm of it, which we refer to as SSF Consulting, but we're all one firm working together. So it looks like our questions are clear now, Cole. Thank you very much for joining me today. Ariane and Dean, thanks for managing the back office there and answering the questions. And Dee, thanks a lot for all your support. Please also visit the SSF YouTube channel. There's a lot of content out there, some small video snippets across a whole variety of topics that you might find useful. Thanks a lot for tuning in today, and we are going to sign off.